Welcome to my channel. I'm the cover call guy, and my goal is to reach $120,000 per year in passive income using only cover call ETFs. Currently, my portfolio yields about $70,000 a year and about $6,000 a month. Legal disclaimer before we start today's video. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making financial decisions. I am just some random idiot you found online and I could be completely wrong. Alright, with that out the way, let's start on today's video. And today's video is going to be on why do cover call ETFs get a lot of hate. When I first started this journey, right, it was always don't do it. One, you're young, go for growth, or it's a scam, it's a scheme. And when I dug deeper into it, it just seems like people were hating on cover call ETFs because at the time there was not a lot of options, and there weren't a lot of good cover call ETFs as of now. Like, we have great ETF cover call ETF managers and companies. For one, Neos, Goldman Sachs, right? Amplify is up there. I think there's a few more top of my head. JetQ has been doing very well. They're pretty much like the rocks, the foundation. They've been holding on and weathering a lot of ups and downs. So there are some good cover call ETFs. When I first started this journey, there was just a lot of the high yield, and it's not sustainable, which is not true at all, right? It just depends on your goals, your philosophy, and what cover call ETFs you buy, right? If you buy cover call ETFs that are you just buy because of the yield, then of course you're gonna lose money on it. You're gonna get resentful. You're gonna hate it. You're gonna think it's not worth it, right? So of course, you have to know what you own. There are a lot of great cover call ETFs today that I'm gonna be going through, and I'm gonna be breaking down why there's a lot of misunderstandings. All right, so let's get started. Today's topic is gonna be why do cover call ETFs get a lot of hate, and then this is just the truth about modern income investing from my research. All right, so the core misunderstanding is that I think there's two goals of there's two primary goals of an investor, right? One is the total return goal. They accumulate, right? This goals primary goal is to beat the benchmark like the SP 500. They see the upside cap of cover calls as a critical flaw, ignoring the income mandate, right? And then there's the income mandate, the distributors, myself included. That's me, right? I used to be on the left, now I'm on the right, right? I see both sides and understand. And a lot of people who just trash talk the income side don't understand, right? The first thing they see is that, yo, it caps your upside. Why are you doing this? What, you're young? Well, because I want to retire young. I want to live my life in my when I'm still in my 30s, right? I want to be able to wake up whenever I want to wake up, right? I don't want to wake up at 4, 5, 6 a.m., an hour and a half commute, 3-hour commute a day, right? And I don't want to have forced overtime. I want to live my life. So there comes the income side, right? The income mandate, the distributors, which is myself, right? This group's primary goal is high, stable, and predictable cash flow. They see the upside cap as an acceptable trade-off for generating massive income, right? This is the solution to the argument here, where you can go for growth and there's nothing wrong with that. I can go for income and there's also nothing wrong with that. Right, and then you have to ask yourself, right, what is your financial goal, right? Goal alignment is everything. A 25-year-old accumulator has different goals than a 60-year-old distributor, right? Critics misalign these goals, judging income tools only by growth standards. For an investor who has built their nest egg and now needs to live off it, prioritizing high, consistent cash flow is the correct financial decision, right? Everybody goes, man, you're young, just work and grow it and grow and grow it, which is nothing wrong. That is the traditional sense. That is the traditional path. And for the most part, it has always worked. And I say most part because, again, you can have growth for 30, 40 years. And then when you retire, the market can cut it in near half, 30, 35, it can just crash, right? Whereas the other side, what I'm doing right now in my early 30s, and I want to just I am accumulating to compound my income, and I'm around $6,000 a month. And when I reach $10,000 a month, I may go for more, right? $20,000 a month sounds nice. $30,000 a month sounds even better. So at 10,000, I can work part-time, optional. I can do whatever I want. I have the freedom, right? Whereas someone who's growing might not have that freedom because, and they might end up going to the income space because growth is not guaranteed, right? Because what if you lose your job? What if you get hurt? Then you can't grow it. Then what is the point? That's another argument to it, right? Everyone has different goals and priorities. Everyone sees life differently, and I'm planning for, in the case of a layoff, right? I can get laid off tomorrow. I can get laid off next week, next month. I don't know. And so this $6,000 a month gives me that cushion. And then the QYLD strawman, right? I see a lot of times online they always point to cover calls that have a bad rep, right? The entire bad rep is built on attacking first generation passive funds like QYLD. This is a classic strawman argument, right? QYLD, like I said, they were one of the first few cover call ETFs that came out. They didn't exactly have a good strategy. As you can see, like their NAV has been completely destroyed, and you might not have even gotten broken even depending on when you invested, how much reinvested, and all that good stuff, right? So of course this is the classic attack the bad cover call ETFs, but they were never talked down or bad against a very top tier cover call ETFs that have held its value and has paid out well, right? QYLD use a rigid 100% at the money overlay. Right, this design is to trade all the upside for maximum premium. This guarantees it will lag in a bull market, right? Versus modern active ETFs like JEPI, SPY, GPIX do not operate this way. So again, when I was doing my research and I was coming and transitioning to the income side of it, I originally fell for the strawman. I did. I'll be honest. I didn't look too much into it because I was like, oh wow, these cover call ETFs don't do well. They don't perform well. But then when I really started to dig into it, because I really felt like growth just wasn't for me anymore. I didn't want to work for the next 20, 30, 40 years. I started to dig more, and I started to find more cover call ETFs, and I started to do more research, and there's layers to cover calls, right? It's not just the highest yield or what if they do the NASDAQ or the S&P. It's important. However, it's also their strategy, which is at the money, out the money, how often they pay, is it weekly, is it monthly, right? A lot of this matters, right? The fund managers, how do they execute, how well they've been executing. If they can't pay out the percentage, do they destroy their NAV for it, or do they just put a lower payment? All right, a lot of these play, right? GPIX, if they don't hit their 8 to 10% target, they just give you less. They're not going to destroy the capital appreciation or the NAV just to pay you, which for me works. I love that. If you can't, don't force a payment. If you can't, hey, look, this was a bad month or this was a bad quarter. You know what? You got less money, but your capital appreciation is either the same, it held the same, and or still has gone up in value. I don't mind that. That works for me. It might not work for other people, but it works for me. All right, and then another fact, the shield work, the 2022 bear market, right? JEPI went down a total of 3.52%. Capital appreciation is an action, right? It's a fact, right? This already happened 3 years ago. And while the S&P SPY crashed, losing almost 20%, JEPI preserved capital, losing almost nothing, right? Simultaneously, it paid out its 7 to 10% cash flow. This is the explicit goal of the strategy, providing a shield and producing income. So, I'm a huge fan of JEPI and JEPQ, right? They've done their job, right? They still paid you during a crash, during a bull run, during choppy markets. They paid out consistently, very nicely. There's swings up and down, but that's as expected. That's how a cover call ETF works, right? It's not consistent like a 10, 15, 20, 25 year dividend payer, right? You can expect more and what to know and how much from a traditional dividend, but also at the same time you're gonna need a lot more money, which is why I also said, I don't feel like building up a $2.5 million for maybe $100,000, maybe $120,000 a year. With 2 million, 2.5 million for an income stock, I'm generating goddamn near like $400,000 with my strategy, maybe even half a million. And then within 4 or 5 years, I would have matched what I've invested, and the rest is house money. So different goals, different priorities in life. This has worked for me, and this is working for me. Um, and once I reach my goal, it has worked for me, right? I mean, I've reached my goal doing this, and for those who's following me on my journey, if you decide to go down this path, I hope it works for you too, right? Because um, I have watched other YouTubers, and I finally said, you know what, I'm gonna give this a try. I'm gonna do my research, and so far it's been paying me well. I've seen the downturns, and I've bought the dip, right? So I would consider myself a more experienced investor, because dips don't scare me. I love the dip. Go ahead and crash the market. I'm just gonna put more money into it. That's my philosophy, right? My I've seen my stock go down by more than 50%, and I still bought it, because when I buy a stock, I do my research, and if it's a great company holding under and these cover call ETFs has great underlying, it's going to recover. I mean, I don't think Mag 7 is going to disappear and just blow up like that, right? If it does, then I'll buy some more. Great. That's just the way I operate. That's my philosophy. I'm a little bit more experienced. For those who are new, I wouldn't dive straight into cover calls ETFs if you're straight and brand new, and I would put more money into a traditional like VOO, and then as you learn, as you get your foot wet, as you kind of experience the highs and the lows, then you might want to transition, right? That's how I would start off. I wouldn't just go straight into income until you actually learn, experience, and see how you perform, your emotions when the markets are at. Everyone does well and they're happy in the good times, right? When the market is like, holy crap, that's when your real emotions and will and your strategy and your philosophy is tested. All right, full cycle medication 2022 to 2023 total return, right? We see JEPI, which is an active cover call, increased by 6%. I use SCHD, a traditional growth dividend ETF, only went up by 1.2%. In the S&P 500, it's blocked out. Crap. But you can see it's probably not even a full percentage. I didn't realize that. Sorry. It's like point something, point zero something. I don't know, 0.09, I think. Over the full volatile cycle, JEPI delivered superior total returns, 2 to 3 times the cash flow, and vastly lower volatility than both its benchmark and its safe dividend alternative. Right? Obviously, I used this year because it was a great year. You can say I'm cherry picking, but it's just to prove a point, right? I mean, maybe 2024, 2025, it doesn't do so well, but again, the whole point is that it did well. This entire year, the stock price went up and it paid well. So, something to think about, right? That all the naysayers are trashing the cover call ETFs. Well, JEPI is a good example that it held well. The sweet spot, right? The sideways markets, right? That's always going to be the best for cover call ETFs. As you can see, for a sideways market, it completely destroys the S&P 500, right? In a flat, choppy market, buy and hold makes $0, right? Cover call ETFs harvest volatility to create a positive return from premiums, winning where the index fails. For the most part, about 90% of cover call ETFs perform to design and excel in sideways markets. And then we have to rebuke the first rebuke, right? A lot of people say JEPQ's high risk adjusted win 3-year Sharpe ratio, right? So JEPQ delivered a superior risk adjustment return, meaning more return per unit of risk taken. The total return argument is an incomplete and amateur level analysis, right? We got to look at the whole criteria, not just one, right? People just say, oh, total return, and then they forget about every other thing too, which I've seen in my comments already. And they just say total return, total return, total return. Yeah, but that's just a portion of it. You have to look at the other portions too. Right, and rebuking number 2, the NAV erosion myth, right? The myth is that return of capital, ROC, is destructive. You see that everybody, especially on Reddit or X or whatever you guys do your research or watch, oh man, return of capital for cover call ETFs is just giving you back your money and the NAV is eroding, which is false, right? It's already been proven with JEPI, right? The fund is just giving you back your money. The NAV is erosion. This is a fundamental misunderstanding of a tax accounting. That's a myth. The fact is that for modern, well-managed funds, ROC is a tax-deferred feature, not a bug, right? They do it on purpose. It is a result of active tax loss harvesting, not capital liquidation. All right. Again, it just depends on your cover call ETFs and their strategy. All right. QYLD, it's not a good example, right? The whole strategy is just to give you as much money by any means possible. And then another fact is that ROC is a tax deferred feature, right? Mathematical proof. I'm using SPY in 2024. Total return was 19.04%, while they distributed almost 12%. It is mathematically impossible for a distribution to be destructive when its total return was higher. It was 95.8% tax deferred in 2024, 95.8% of QQQI, and 93.9% of SPY distribution were classified as this tax efficient ROC. And these are facts. You can look it up on the website. All right, the tax secret weapon, right? Section 1256 contracts. The standard ETF, such as QYLD, uses options on ETFs like QQQ. All gains are taxed at 100% short-term capital gains at your highest ordinary income rate, versus a modern ETF like SPY and QQQI uses option on indexes like SPX. These are section 1256 contract, taxed at favorable 60% long-term and 40% short-term rate. So again, I bring this up because I always see on Reddit, you see, the Boglehead community, fire community, or dividend community, when you talk about income, or you talk about you just mentioned a cover call ETF, they will attack you and be like, no, it's great, the yield is unsustainable, ROC is just giving you your money back, right? And you're taxed at such a disadvantage. All of this just proves that a lot of people don't know what they're saying, right? They haven't looked under the hood of the cover call ETFs. They haven't done their research and studies with the fund managers and how their prospectus. They haven't read that. They haven't actually looked at how they're paid out. They actually haven't done the full max stock timeline, 5-year, 3-year, 1 year, year to date, right? One day. They haven't done any of that research. So reading through these Reddit comments and comments on X, you see that a lot of people just they have that, they're stuck in that traditional investing, and that's the only way that's the only option that they think will work, which is obviously not true. And rebuking number 3, which is active management wins, right? Dynamic overlays such as GPIX can reduce the overlay in a bull market to capture more upside or increase its harvest for more premium. Smarter strikes, like what JEPI does, uses out of the money options to build in a buffer for growth, unlike QYLD rigid at the money cap. And then call spreads, like SPY sells a call and buys a further out the money call, explicitly retaining a large slice of the upside potential. So you see, like, it's all strategy, right? A great ETF, a great cover call ETF have such good strategies that GPIX displays, JEPI display, SPY displays, right? A lot of people don't mention that, especially when they just think about how high they automatically it's a high yield, so it can't work. It might work for a month, 6 months, or might work for a year, but they don't understand how they're getting that high yield, right? There's a strategy to those payments. There's a strategy to GPIX yield, or JEPI's yield, or SPY's yield, right? A lot of people don't dig further than that. They just do the echo chamber, and then they say it's bad. So that person said it's bad, then the next person says it's bad, and then it just goes on, and then everybody starts saying it's bad. And of course, I was influenced by that too. I will admit, I was that ultra growth. I was into growth and the dividends and the traditional dividends, right? And then when I start realizing that cover call ETFs are actually a amazing wealth builder, wealth compounder, right? As long as you know what you're buying, right? You always have to buy a good product. Otherwise, you're just buying a product that looks flashy, and that always gets you burned. And I've been burned. The core satellite income model, right? So a lot of people just assume they buy every single ETF in the portfolio is just crazy 30, 40, 50, 60% yield. Again, those are the people that haven't done any research. Those are typically the newbie investors, the new investors. Those are the typically the investors that are just greedy, right? They just think high yield and that's it. I'm going for it, right? Instead of mixing a good chunk of top tier superior covered call ETFs, in my opinion. An example here is Core. My core would be SpyEye or JetB. Those are two examples. There's plenty more. I'm just using two. All right, these two provide a high, stable, tax-efficient income base by harvesting low volatility of the SP 500. And then my satellite. These are what I would be using to try and boost my yield to get more favorable, bigger payouts. But at the same time, I know these two could be extremely volatile, right? Acts as a high octane income generator by converting the extreme volatility of tech and crypto into massive uncorrelated cash flow, right? So I can understand, yes, these two can swing up and down in price and in payment. That's why they're my satellite, right? So a lot of people that make the argument on the social media, they don't mention that. They just think you're getting crazy yields. And for the most part, Maggie and BTCI are high yields, but I wouldn't say crazy because there are crazier yields than this, right? Maggie, I believe 25, 28%. BTCI is about the same. And then you have like the round hill and then yield max where it's absolutely monstrous yields, right? At 50, 60, 70, 90, 100. And I think at one time it was even over 100. Now, of course, in my opinion, those would be unstable or unsustainable or both, right? Unstable and unsustainable. Those are the ones you get in at the right time, you go up, you get out, let it fall back down, maybe get back in and nibble a little bit, let it go back up and get out. Those are the ones where again, another misconception is that people think that those are the ones that you buy and hold. Those are not buy and hold, right? In my opinion, the example that I gave right here, the core satellite income model, these are more of buy and hold. Maggie does the Mag 7 and only Mag 7. Now, would you guys actually buy the Mag 7 stock itself? I would hope so, right? I mean, if you guys want to build generational wealth, Mag 7 seems like a good choice. Would you guys get, if you guys get into crypto or you're into crypto, would you buy Bitcoin? I hope so. I mean, Wall Street is already adopting the blockchain technology already, right? They're not thinking about it. They're not about to. They're already doing it. So what's using the blockchain technology? Bitcoin. It's all an ecosystem here. You guys see what's happening? So those are my two favorite. Those are my what I personally disclosure here, what I own. And those are my satellite positions. Those are going to be my $150,000 position in each. And I don't think I'm gonna go more than that. All right, I'm rebuking number 4, which is the bond fallacy, the 2022 total return, right? In 2022, with raising rate environment, JEPI was factually safer and superior to bonds, providing a high yield and dramatically better capital preservation. The showdown, I'm gonna use JEPI versus the safe alternative, which is SCHD. When it comes to defense, right? JEPI has a 3.5 versus SCHD versus a 3.2. Going on the offense, JEPI wins by a two times upside. Cash flow, JEPI wins by 2.5 times the income, right? JEPI offers some bear market defense as SCHD, but delivered double the offense and the recovery and 2 times more the cash flow. So again, JEPI is crushing it, right? Maybe in the comments people will say, "Oh, don't use SCHD. It's been down the entire year," but it's a good example because, well, if you go over how well SCHD's been doing other years, I mean, it's essentially one of the best dividend growth stock. So that's why I used it. And I used it for the year of 2022 and 2023, not the year of 2025 where it's getting beat up. the strategic win, right? Solving the sequence risk, which is short for SOR. Sequence the retirees grade is fair, which is sequence of return risk, which is being forced to sell a share in a crash to fund your lifestyle, permanently locking in losses at the worst possible time, right? It's like, oh my god, how long will my portfolio last? But with high cash flow from cover call ETFs, it solves this problem, right? You live off the income and never have to sell your share in a downturn. The SPY and SCHD investor was forced to sell. The JEPI investor cashed their check. So that's the huge difference, right? I'm here to live off of my cash flow, and then and of course, personally, I'm not going to spend all of my cash flow because one, I want to treat it like a paycheck and put some aside. I want to be able to reinvest some and build more cash flow every month, right? I want to increase it. My goal right now is $120,000 a year. If I were to reach my goal and completely retire, the next year I want to be at maybe 130, 135, right? There's always going to be inflation. 120 is not going to be enough in the next 3, 4, 5 years, but the way they're printing money. The behavioral edge, a sleep at night strategy, right? Prevents panic selling. Seeing high dependable income arrive even in a crash provides a powerful psychological boost to stay invested and not sell at the bottom. For example, myself, when there's a crash and I get paid, I buy the dip. That's what I do. I mean, I love buying great cover call ETFs at a lower price, because those great cover call ETFs hold great underlying. They hold great companies, and these great companies are gonna recover. And when it recovers, the stock price recovers and the payment goes up. So you see, for me, it's a win-win. I don't see the loss here. And it provides a smoother ride, right? The cushion from the premiums mitigate volatility. Seeing a negative 3.5 loss on JEPI instead of a negative 20% loss on SPY makes it vastly easier to remain calm, right? If your stocks are crashing and you're like, oh my god, do I just get out? Do I buy the dip? Right? If it's falling, some people might panic. Some people would sell. My verdict, right? The hate for cover call ETFs come from critics using the wrong tool for the wrong job. They attack a passive, obsolete fund, in my opinion, QYLD, for failing a test it was never meant to take, right? It was never meant to beat growth stock. But people always compare cover call ETFs to growth. Why? It doesn't make sense. I'm not here to buy QQQI and SPY because it could 3, 4, 5, 6, 7x in 2, 3 years. I could care less, right? As long as their NAV is stable and it goes up a few percentage, maybe every other year, I'm okay with that. I am okay with that. As an income investor, as long as their payment is consistent, their payment is increasing, which it has been, I'm okay with that, right? The whole point is income. The truth is that modern active funds are data proven, tax efficient, and provide a vital sleep at night strategy, which I like my sleep. I don't want to wake up at 2, 3, 4 a.m. checking the phone every goddamn time. I'm like, oh my, I'm sweating, right? For a true income investor, they are the right tool for the job. And guys, if you watched to the end of the video, I appreciate it. I would like to hear what you guys think. If you guys are in the income journey like myself, and you guys or you guys are thinking about it, let me know what you guys think. Have you come across the same research I've come across, and it's just nothing but hate? And when you've done your own due diligence, you came across something different like me? Well, let me know, man. I really appreciate if you leave a comment and leave your thoughts, because that lets me know that, hey, maybe I'm right. Or if you think I'm wrong, you know, I love to do more research. I love to dig into things and read more. Perhaps you teach me something. Conclusion, right? The right tool for the right job. The bad rep is a myth based on obsolete funds and misaligned goals. For an income investor, income-focused investor, modern cover call ETFs are a data-proven, tax-efficient, and behaviorally sound solution. That is my take. That is my conclusion. And go ahead and join the conversation. Like, comment, subscribe. I'll catch you guys on the next. Stay tuned. Thanks for watching.